Inflation in the euro area is undesirably high, and it is projected to stay that way for some time to come.
I wouldn't be surprised, and it's actually in my forecast, that growth will slip below 2%. But it won't actually pivot down into negative territory.
It'll be in that kind of, deep recession territory if you wanted to really get inflation back to the kind of price stability definition that we've seen in the last decades, around 2%.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in Sintra, Portugal, for the ECB Forum. And here's what's coming up on today's program. Inflation and growth fears. Weak U.S. consumer sentiment hits risk appetite. France cuts its GDP forecast. And Spanish inflation unexpectedly soars to a record. A herder falls while Finland and Sweden take a major step towards NATO membership after Turkey drops its opposition. Plus, Sintra Spotlight, I sit down with the world's most powerful central bankers, including Jay Powell, Christine Lagarde, Andrew Bailey, and Augustin Carstens. Now, first thing is first, so let's check in on the markets. This is a picture across the board for what we're seeing in Europe. We did see a little bit of pressure. That comes from Chinese equities, and that was a little bit earlier on. So stocks dropping. Again, renewed worries about economic growth. Monetary policy tightens in much of the world to fight inflation. And, of course, the million-dollar question is whether they will tighten too much and put the economy in jeopardy. European equities are falling for the first time in 4 days. Again, sentiment also hurt by China remaining committed to its zero-COVID policy approach. And then if you look at Spanish inflation unexpectedly surging to a record, and that's really dashing hopes that inflation in the Eurozone's fourth biggest economy had peaked. It may also embolden ECB policymakers pushing for big increases in interest rates. European stocks down 0.1%. Now joining us now is Mark Hafele. He's Chief Investment Officer at UBS Global Wealth Management. Mark, great to speak to you. I know there's a number of confluences and a number of factors that are actually changing the way we look at equities and markets. Is there a danger, or is it now almost a given that it's impossible for central banks to engineer a soft landing?
It's not given that we end up in a recession or a stagflation, but of course, as many people have said, it's getting harder and harder to put a stronger probability on the soft landing as we're starting to see things like manufacturing roll over a bit, consumer confidence roll over. Those are surveys, but we are starting to see a little bit in the hard data. And of course, earnings haven't been really taken down yet by the sell side.
So what does it mean for stocks going forward? Does the rotation continue, or could we see worst case scenario?
Well, I think that the way we're trying to think about this is really we've got a broad range of outcomes based on a lot of decisions by powerful people around the world. You know, what is going to happen? How much will the G7 support Ukraine in the war? How much will the ECB or the Federal Reserve continue to hike? In some ways, these are unknowable. So be prepared with a portfolio that contemplates how would you position if we do get more of a slump, and how would you also position if we move towards a soft landing? Yeah. And so we've tried to come up with a mix of assets that can do that.
Which means that, you know, where do you tilt within equities, for example? Where do you still find value?
Well, we think that for the major indices like the S&P 500, it's going to be pretty difficult to push above something like the 3,900 level. But below that, we would tilt towards value, because we found that value tends to outperform growth when you have inflation above 3%. And we're going to end this year with inflation above 3%. And then we're also looking for opportunities to tilt towards some more defensive sectors like healthcare, and also looking at, you know, where can you find stocks that are going to provide an income if we're in a more recessionary environment.
So, Mark, how much do you have to diversify, given all of the probabilities of what could happen in various parts of the world, and what do you diversify into?
This is definitely a time where we're diversifying. I think for most investors who've been very focused on, you know, doing well by even if they're just in ETF of a major index, what we're trying to say is, look, this really is a time to diversify globally, but also to look at things like currency. So, in a more slump scenario, we'd be looking for the Swiss franc to gain ground. But we're also staying into commodities. We believe that the supply-demand picture means that commodities can remain strong. And so we've also taken positions in commodity currencies like the Australian dollar or the Canadian dollar.
Mark, overall, when you look at some of the defensive stocks or some of the strategies out there, is there a region that looks more attractive than others? And what do you do with Europe right now, given the proximity of Russia and also the fact that the ECB seems to be really behind the curve in fighting inflation?
Yeah, we're looking at it more with that value tilt, but when you do that, what we've found is that it leads us to above average allocation to the UK, where there is a strong cyclical energy commodity tilt and also strong valuations. And it also puts us a bit more into, say, Japanese companies where we're finding more value as well.
What's the ideal portfolio if we look at a protracted stagflationary environment?
I mean, in a stagflationary environment where you're having this inflation remain higher, I think you want to try to go for more of a commodity tilt, because they're going to give you some of this protection against the inflation. So I think that would be the number one recommendation if that continues. And of course, the commodities still remains an effective hedge against a lot of the geopolitical tensions that we're facing.
Mark, thank you so much. Mark Hafele there, Chief Investment Officer at UBS Global Wealth Management. Now, Finland and Sweden have been invited to join NATO after Turkey dropped its opposition to their bids. Meanwhile, NATO Secretary General Jens Stoltenberg has also confirmed that China is now part of a new strategic concept for the alliance. Now, for more, we're also joined by Bloomberg's Maria Tadeo, who's at the NATO summit in Madrid. So, Maria, good morning again. How significant a breakthrough is this in terms of the Swedish and Finnish bids?
Well, Francine, it is a real breakthrough, and I think we need to take a step back and see why, or the reasons behind this move from Sweden and Finland, who are now ditching their neutral policy when it comes to Russia and now perceive it and see it as a threat. Now, yesterday, Francine, the Turkish leader, Mr. Erdogan, did meet with representatives of Finland and Sweden. They did have a meeting and, of course, came out with this breakthrough in which the Turkish now say we're not going to object, and in fact, we will support their candidacy to NATO. We have the reassurances that we need. And if anything, this tells you, Francine, that this could not be turned into a political football at this point, where the dangers are so great, according to the NATO Secretary General, and the concerns for these two countries was to be stuck in limbo in the face of Russia. So this is a real breakthrough. It really is a historic moment and a real change in terms of European security as a result, of course, of the war in Ukraine, which has accelerated so many changes here already.
Yeah, so Maria, we're seeing possibly really the biggest strategic overhaul in NATO since the Cold War. Is the Ukraine invasion and the new concept regarding China actually bringing us back to the dynamics of that era?
Well, Francine, it sounds a little bit like that. The Secretary General did give some indications today. He said the scene. He didn't talk about the Cold War specifically, but he did say this is, quote, the most serious security moment for the NATO alliance since the Second World War. He did also say the world is changing and has changed dramatically. It is becoming now a global competition and a dangerous place, which means we have to update our strategy. That is, of course, the strategic compass for NATO for the next 10 years, which now will brand Russia a threat to security, China a challenge, and then, of course, repeat that security, of course, it costs money, but it does or represents a fundamental pillar of democracy. That 2% needs to be the bare minimum. It is not the ceiling, it's now the floor for defense spending.
Maria, thanks so much. Maria Tadeo there in Madrid at the NATO summit, doing a great job, of course, on the ground. Coming up, what's keeping the world's top central bankers up at night? Well, we'll talk global monetary policy live from Sintra and the ECB Forum. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Sintra, Portugal. Now, pressure is definitely building on central bankers around the world to control surging inflation as they gather here in Sintra for the ECB annual forum. Now, with us now is Adam Posen, president of the Peterson Institute for International Economics, one of the most brilliant minds also to talk about economics and what they got wrong. Adam, can they fix it, or is it now too late because they have to be so much more aggressive in fighting inflation?
They can fix it, but it's more costly than if they had gotten it right. And I want to be very clear. I think the Bank of England and the Federal Reserve got it wrong much more than the ECB did. Both of them, the inflation was coming. It was a much bigger balance of wage inflation or domestic demand inflation versus supply shocks. But they can still fix it. It's just more costly.
Do you have a good understanding of how much the Fed is willing to hike at the expense of economic growth to make sure that inflation is under control? Like how much will that pain be? I think
the amount they're willing is basically unlimited at this point. You know, there was all the talk for years about the Greenspan, Bernanke, Yellen put. Well, we've seen there's no put on equities right now because that was just a reflection of a zero inflation environment. It's, to use the term lexicographic, it's they have one goal, and until that goal is met, they're not going to trade off on the rest of it. But how far will they have to go is the real question. I think they're agreed and they're committed to going past neutral, meaning they'll get to 4% roughly by January or February. The question is, do they have to get to 5.5 or something like that, like my colleague Olivier Blanchard or Larry Summers would say?
But what does that do to the economy?
That's bad. Again, it's not inevitable recession, but it's pretty high chance. The issue is how much does unemployment rise in that situation? The good news is on a structural basis, I mean, everybody, I certainly am humble about saying this after 2008-9, but it's night and day looking at corporate balance sheets, at household balance sheets, at the amount of leverage. So, you know, the amount of damage from a recession, though in human terms high, is not going to be as big or lasting.
But Adam, do you think this is the end of the all-powerful central banks because we really see the limits of their reach?
Yes and no. That was always overdone. I mean, it was overdone 25 years ago when they were talking about that way about Greenspan the maestro. But at the same time, we do have this mission creep of central banks. They want them to get into climate. They want them to get into social justice. And I'm not making fun of that, but it's just a general problem. We're seeing this with sanctions right now, that policymakers in the US and other Western democracies want to use finance rather than actually do things through legislation.
So what does that mean? Where are we going to end up in 10 years, actually?
In 10 years. In 10 years, I'm not worried.
If we survive the next 2 years.
God willing. You know, I think the odds, forecasting more than 5 years out is insane, but I think the odds are much more likely we're going to be back in a low inflation, low return world. If the change, the green change that we need is underway, that might get us out of it somewhat, but it's probably not productivity enhancing or inflationary in the short term. It's probably disinflationary in the short term.
I know you worry about the Bank of England. What's the way forward now for Andrew Bailey?
I think the MPC of the Bank of England has to be more aggressive. I mean, in terms of the rate they're tightening at, they can say, well, we're tightening faster than the Fed or the ECB, but that's not the point. The UK is now a smaller, less open economy. Brexit, I think, is amplifying the same shocks that everybody's getting. The credibility of the regime, not so much the bank itself, but the overall regime is down. And imported inflation is going to be up with the pound declines. So I think it's not just they have to move, but they have to keep moving. So unlike the the US or the Euro area, I think they really do have to go into recession. I think they really do have to put interest rates up more than, say, the Fed would.
But, I mean, it's very problematic, right, from a political point of view. I mean, I know they're apolitical, but actually hiking when there's a downturn.
Well, people have been talking about this. I mean, in a lot of countries, in the U.S., and you get pushback, and people say you don't hike during a recession, or central banks are unwilling to. That's true if you have the luxury. But if we look back at the 80s and 90s, let alone the 70s, in England, in Italy, in various emerging markets, in Canada before inflation targeting, you know, you did hike into recession. Even in early 80s, Volcker, the first Volcker disinflation, was hiking into recession. That's the point. When you've lost some credibility and you got too much inflation momentum, that's what you have to do.
But so that means, and I'm thinking about the ECB, but also maybe Bank of England, do we need to get rid of gradualism and just go front load, just be very aggressive now, even if it means then lowering rates further down the line?
I think the Eurozone, therefore the ECB, has a very different problem than either the Fed or the Bank of England.
I think supply shock.
It's much more a supply shock, much less an aggregate demand issue, much less a wage issue. And so to me, I think that if the ECB front loads too much, they're just going to bring on the recession that's probably already likely anyway and overdo it. For the Fed, it's the amount of front loading they're doing. It doesn't really matter what they do between now and January as long as they get to roughly 4.
Yeah. But if we game theory, and I know this is game theory, but let's say, into the winter, there's a gas embargo, so we need to consume much more gas and oil to heat ourselves. Russia turns off the taps, and this is the point where actually the ECB is meant to hike. Can they continue hiking?
I think they shouldn't. I mean, my point is I don't think the ECB needs to go much beyond what they're promising to do in September. I would prefer to look at President Lagarde's comments yesterday as not so hawkish, as a correction to the empty fuss over anti-fragmentation that nothing was going to get in the way, I think was right. But she talked about flexibility, she talked about optionality, she implied data dependence. And I think for the ECB, again, differently from the Fed and much differently from the Bank of England, that's the right call.
When do we see peak inflation?
In Europe, not until next spring because of the winter factors you just talked about, Christine. Francine, sorry. I think Christine Lagarde, Francine Lacqua, sorry, you're all the same. Sorry.
What an honor.
No. You'll be next. You'll be next president. Joking aside, sorry, Francine. The peak inflation in the U.S. is probably very soon. It's a little later than we thought, but it's coming. If it's not, it will be because wages are much stronger. That doesn't mean as high as inflation, but stronger than we expect. If wages continue to go up, then Summers and Blanchard and Furman are right, and you have to be more aggressive. But I'm assuming, or not assuming, forecasting that we're going to peak in the U.S. soon. In the UK, it's much more uncertain. I strongly doubt they peak anytime soon.
Adam, thank you so much, as always, for coming on Bloomberg. Adam Posen, the president of the Peterson Institute for International Economics. Now, we'll have plenty more, of course, from Sintra. Today at 2 p.m. UK time, we'll be hosting this panel with the world's most influential central bankers, Christine Lagarde, Jay Powell, Andrew Bailey, and the BIS General Manager, Agustin Karsten. So we'll have plenty more from that. And then we're also looking at live pictures from NATO. President Biden just arriving earlier, but now talking. I think they're actually briefing reporters in Madrid with Mr. Stoltenberg of NATO. We'll have plenty more on that throughout the program. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, actually not in London, in Sintra, but looking at Madrid. It's all confusion. It's like when you're around the world in 80 days. Right, the action is also happening in Madrid. That's where President Biden is meeting with Secretary General Jens Stoltenberg. President Biden saying that the U.S. is enhancing force posture in Europe. He's also saying that they want a permanent headquarters in Poland for the U.S. Fifth Army Corps. And then Mr. Stoltenberg moments ago saying that actually the war was started by Vladimir Putin in Ukraine because he wanted less NATO, but he's now getting more. So we'll look out for, of course, any other breakthrough in NATO. Is a pretty big deal that Turkey said yes to Sweden and Finland joining the alliance. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. A former White House aide has offered a vivid portrait of Donald Trump's behavior during the January 6th Capitol riot. Cassidy Hutchinson says Trump knew some of his supporters were armed when he told them to march on the building. Hutchinson also says she was told Trump tried to take the wheel of the presidential limousine when he wasn't allowed to travel to the Capitol during the attack. The former president said that incident did not happen. Now, JP Morgan no longer has any exposure to the nickel bit that rocked metals markets earlier this year. This after a drop in prices on the London Metal Exchange allowed the tycoon at the centre of the massive short squeeze to exit his positions with the bank. JP Morgan emerged as the largest counterparty to the bet by China's Shang Holdings. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine, back to you. I'm in London, of course.
You're in London, I'm in Sintra. I will remember that. Leanne, thank you. Now, coming up a little bit later on Bloomberg, the world's most powerful central bankers talk to me a little bit later on. Jay Powell, Christine Lagarde, Andrew Bailey, and Augustin Carstens join me for an exclusive conversation at 2 p.m. London time. This is Bloomberg. Inflation and growth fears, weak U.S. consumer sentiment hits risk appetite. France cuts its GDP forecast as Spanish inflation unexpectedly soars to a record. A hurdle falls. Finland and Sweden take a major step towards NATO membership after Turkey drops its opposition. Plus, Sintra Spotlight, I sit down with the world's most powerful central bankers, including Jay Powell, Christine Lagarde, Andrew Bailey, and Augustin Carstens. So good morning and welcome to Bloomberg Surveillance Early Edition, everyone. I'm Francine Lacqua here in Sintra, Portugal. Now, South African inflation surged above the central bank's target range for the first time in more than 5 years. I met with the South African Reserve Bank governor earlier today and asked him how price pressures will factor into the upcoming monetary policy decisions.
We had been worried about inflation from last year. Monetary policy now is risk-based, and so as early as November last year, we took a view that inflation is going to rise. We expected that it will be outside of our target in the second quarter of this year. We thought that it will go out to 6.3. It came out at 6.5, which was slightly higher than what we had expected. But there is no doubt that inflation around the world is rising. And we had to start recalibrating policy as early as November last year. We were initially moving at rates of 25 basis points. Then we moved on to 50 basis points. And in a way, we do not even see it so much as a slamming of the brakes, or if I was to use the analogy of a motor vehicle. But it is more like taking a foot off the accelerator than slamming on the brakes. But
Governor, do you have to accelerate actually some of those hikes? I think the market is pricing a 75 basis point hike this year.
Well, our baseline scenario, which is captured in the quarterly projection model of the Reserve Bank, the forecast for this year is for 25 over the course of the remaining 3 meetings of the year. But that is a guide. That is just a broad guideline. We can deviate from that. And actually, we did deviate from that in the previous meeting and decided to do 50 basis points. We are in uncertain environment. Data becomes important, but you can't wait until you see concrete evidence that second round effects are kicking in. You are going to have to take a view about the likelihood of the second round effects kicking in and thus acting. So,
Governor, first of all, so you're suggesting, it seems, that actually a 50 basis point hike is maybe more likely than 25, just to kind of really nip it in the bud?
It's definitely not off the table. We did 50 basis points at the previous meeting. We will look at the data as we go into our policy meeting in July, and we would act appropriately. And I think that the fact that we have been able to act earlier gives us the space to move at a measured pace. But that, as I had said, does not take the 50 basis points off the table.
So are you worried that developed economies, basically, because they didn't start as quickly as you to hike rates, now have to be more aggressive and will push the world into a recession?
Well, I'm looking forward to the discussion of the developed economies this afternoon so that I can gain an insight from what they are saying. I've got no doubt central bankers around the world are much more familiar with their own economies than most people are. what is in no doubt is that inflation surprised almost all of us on the upside, and policy would have to be recalibrated so that we could actually deal with inflation going forward. The concern for us here would be if inflation expectations become de-anchored, and that is thus it is appropriate that central banks act with speed.
Well, that was the South African Reserve Bank Governor Letega Kganyago. Now, to talk, of course, about some of the pressure that is building on central bankers around the world to control surging inflation as they gather here in Sintra for the ECB annual forum. With me now is Richard Baldwin. He's professor of international economics at the Geneva Graduate Institute. Professor, thank you for joining us. Now, your specialty is trying to understand, of course, how these ever-changing economies will evolve. First of all, a simple but probably the most difficult questions of the day is that it seems like everything is going faster and faster because of digitization. Does it mean that if we see a recession, we'll come out of it quickly because everything moves fast, or could we be stuck in a recession like, 08 or even the 70s?
Well, that's an interesting question. I mean, digitization has definitely accelerated some things, but many of the things that cause recession, like hiring people, firing people, starting investment, or storing inventory, has very physical constraints, and so it may be not accelerating as fast as it would be. So I can kind of see the point that it might change the speed, but I don't think perceptibly enough to like a quarter faster or something like that.
Have we underestimated the way that our economies and actually the way of living have changed because of digitization, but also because of COVID, the work from home situation? And what does that mean on how central banks should look at some of the data they're looking at?
Yes, well, absolutely. That's basically what my last two books have been about, is that digitization has changed.
It's as if I knew.
Exactly, exactly. No, I say it's changing the world faster than most people believe and in ways few expect. So my focus recently has been on the service sector. So much of the discussion on shows like this has been about globalization and automation of the manufacturing sector. Yep. And what I'd like to point out is that this is now coming to the service sector. Both automation through machine learning stuff and globalization through outsourcing things. And you mentioned COVID. COVID essentially took us to a frontier which made it much easier to offshore certain tasks and certain occupations.
But that would be deflationary.
Absolutely.
But we're not in a deflationary environment.
No, well, so it is a structural thing, so it's like a pretty long run trend. We're already seeing it, but for it to move the dial on deflation, we're talking about 5 or 10 years, and it's a structural change which is bringing in imported deflation in the rich countries.
So what does it mean for the kind of inflation that we're seeing? And this is, there are market participants or certain economists, maybe some former central bankers that say, like, look, this is a supply shock inflation. So actually, no matter what central banks do, they're going to find it really tough to deal with it. Your research and your book would point to that, right? That we have this underlying deflation coupled with supply shocks.
Yeah, I mean, I think that's right. But I mean, the people around the table here, they're stuck with something's going to happen over the next 2 to 6 quarters. So what I'm talking about is something that maybe their successors are going to have to worry about. But another aspect of that, and I've been focusing on services, is one of the strange things in the economy now is that during COVID, there was a switch from spending on services to goods, and that's unwinding now. Yeah. And because services are so much more job intensive than goods, that's providing a great big upswell that's hopefully countering the pressure that the central banks are putting on the economy in order to slow inflation.
But how long does that last? And we've seen it in the inflation data, right? It's airline tickets going up. It's some of the things that we haven't been able to do for the last 2 years that suddenly are
waiting at the
up.
airports lines, for example.
So nice, right? with all your baggage lost.
How long does that last? So I would say a few quarters. I mean, but on the other side, it's not clear that this is the last shock we're getting out of the whole thing. And the truly unusual thing is COVID, in some sense, was 2 shocks. There was a shock in Asia on supply when it hit them first. Then it was the lockdown shock in the West, if you will, and then a series of those. And then the Russian invasion of Ukraine. All these came out of nowhere. There's nothing to say that there's not going to be another one. And I think
what could that other one be?
Well, it could be a revival of COVID. If the next variant of COVID is a little bit more virulent than the last one, we could have another lockdown, for example. There is some possibility of an emerging market debt crisis, which could cause problems, scare investors around the world. But the whole point about crises is if you could foresee them, you mean do them. But this idea of the unwinding into services, I think that's something that takes a while, partly because there's a shortage of workers and people are just having trouble providing the services.
Yeah, which is why so many people are also asking for raises, which is not helping with inflation. Richard, thank you so much for coming on. Richard Baldwin, they're Professor of International Economics at the Geneva Graduate Institute. Now, coming up, Lithuania Central Bank Governor Gedimias Simkus joins us here in Sintra. We'll ask for his view on a potential 50 basis point rate hike and what that would mean for inflationary pressures in the Eurozone. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here at the Sintra, at the ECB Forum. Now, with us now, Gedimias Simkus, the chairman of the board of the Bank of Lithuania and member of the ECB Governing Council. Thank you, Governor, for joining us. There's so much to talk about. Inflation. First of all, what does the ECB need to do now to keep inflation under control?
The ECB needs to continue its monetary policy normalization. This is what ECB or as Governing Council started doing in December.
Of course.
And this is what we are going to do in future to have, to fulfill our task, to have price stability and to achieve 2% inflation in the medium term.
Governor, you believe that 50 basis point hike should be on the table for the July meeting of the ECB. I mean, does this make the most sense to front load and actually try and nip this inflation in the bud before we get into the winter months with a possible gas embargo?
Well, in June, they had data what we had, and they made a decision, like expressing intention to raise by 25 basis points in the end of July. If the data changes in, like, we see inflation acceleration in comparison to what we have seen in the beginning of June, of course we should think like more powerful decisions to keep inflation back. But
Governor, overall, it feels like a central bank has to actually take a view on what happens to inflation in the next 4 or 6 months, and do monetary policy for that. Not look at the data now, because then you're constantly behind the curve. Is that not fair?
Not exactly forward 6 months, but forward 2-3 years, right? This is what matters. And because the monetary policy, its decisions take effect only in a year or 2 years. So, I understand the pain that people feel about this current or very high levels of this headline current inflation. But unfortunately, this inflation that we observe, it's already experienced inflation. It's already the past. So we look to the future and we do what is needed to have inflation back to the levels of 2%.
Do you think the ECB will be able to manage inflation and get it back to 2% without inflicting too much economic pain?
I'm the part of the Governing Council. I can promise I do what it's needed to fulfill our financial stability.
Where do you see fragmentation? So again, we've had some assurances that this is something that, of course, the ECB can deal with. Do we need a new tool to make sure that doesn't happen?
Well, fragmentation, I see, or risk of fragmentation is a concern, and therefore the Governing Council decision was to accelerate work in the ECB and Eurosystem committees to have this new anti-fragmentation tool. It's very important to have, in my point of view, is just because it would act as a backstop, and that the risk of fragmentation would remain a risk of fragmentation and not the fact of fragmentation.
So does it need to be a new tool that's so big that actually deters the market from testing it?
It's not about being big or small. It's about being credible, and that market perceives or sees the ECB commitment to use the tool if it is needed.
The problem is that there's at some point a political judgment, right, on whether you're helping with the debt of certain countries that maybe are not doing some of the structural reforms, or whether it is really a widening of the spread that's unwarranted.
That's a very good question, and that's a tough question because it's about the criteria, right? And to some extent, it's also like, it's a tough question, and this is exactly the question we should discuss within the council and at the expert level, to have these criteria clear. But there is no magic ball, there is no magic stick, there is no one magic criteria right? By which you can define if this is fragmentation or not. One needs to take a holistic view and see like the full picture. Yields, change of yields, spreads, change of spreads, etc.
Governor, what's your biggest concern right now?
My biggest concern is that that we continue working on like keeping anchored inflation expectations and not working later on how to re-anchor inflation expectations that they anchored.
Do you think there's a danger now that they risk de-anchoring because we talk about inflation so much in the press and people that, in the past maybe were not that interested on economics and inflation?
So our decisions are data-driven, and we are on the path of monetary policy normalization. Now we are at the time when we expressed very clearly that we are going to hike interest rates, and we are coming to July where we hike them, and we continue doing this until we fulfill our task.
What should be the message for citizens in your country, but also in Europe, that are struggling with the cost of living right now?
One needs to understand that this painful period of high inflation comes from the external factors, and one of those factors is Russia's unjustified aggression against Ukraine with all the consequences. So it's a difficult time, but it will go away it's a matter of time.
But is there a danger that if we have a gas embargo from Russia, then it will be impossible to hike rates further for the ECB?
Not really. I think we are determined to maintain our price stability objective.
We had some, CPI from Spain today. Do you see really, some of the CPI staying, this inflation basically staying here longer, and also countries that didn't have this kind of environment in the past?
Well, I think these inflationary pressures become more and more broadly based, and this is the thing we want to tackle. So the inflation has stayed for longer than we have expected before, but this is for different reasons. Yeah. In the beginning, we had a resurge of aggregate demand, and there was a lack of supply. Now we have effects of the Russian war against Ukraine. And unfortunately, the high levels of current inflation is the consequences of all these developments. But
we've also seen quite a lot of volatility with euro and currencies. How much, does this add in terms of problems to the ECB Governing Council?
We are dealing with the inflationary pressures, not the volatility of currency exchange.
Okay, I like that. We have a lot to deal with. That's not our problem. Thank you so much, Governor,
for
joining us today. Gedimias Simkus there, the chairman of the board of the Bank of Lithuania and member of the ECB Governing Council. Now let's get straight to the Bloomberg First Word News. In London is Leanne Gerrans. Hi, Leanne.
Hi, Francine. Finland and Sweden are closer to joining NATO after Turkey dropped its opposition to their bid. The two countries pledged to address President Erdogan's security concerns, especially around Kurdish groups that Turkey considers terrorists. Membership for the two previous neutral countries will take months, but marks a big shift in Europe's security landscape. Now, Ghislaine Maxwell has been sentenced to 20 years in prison for sex trafficking and other charges related to helping Jeffrey Epstein sexually abuse underage girls. The prison term could be an effective life sentence for Maxwell, who is 60 years old, but is less than the 30 to 55 years sought by prosecutors. Walgreens Boots Alliance has abandoned the sale of its Boots pharmacy chain. The company says it failed to secure the desired valuation for the UK business amid a turbulent credit market. The deal was expected to bring in more than $6 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, coming up, Tesla lays off 200 workers as the electric vehicle maker shutters its California facility. We have more on that story next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Sintra, Portugal. Now let's get to a Bloomberg scoop. And Tesla has laid off hundreds of workers on its autopilot team after the EV maker shuts a facility in California. For more on all of this, we're joined by Bloomberg's global car czar. He is Craig Trudell, an avid also Elon watcher. Craig, so what was the role that these staffers were actually doing?
So these people were doing data labeling and annotation, and what that means is really sort of supervising and training the self-driving system that Tesla has been working on for years to at some point get its cars to be able to drive without human supervision. And so essentially what you have here are humans sort of getting involved with identifying and labeling things that you encounter every day on the road. So, lane markers, other vehicles, road signs, and so on, and essentially teaching the computer to sort of recognize those things for itself and supervise that there's sort of progress being made on that front. What Tesla has been trying to do is, really sort of, automate more of that, because when you think about the amount of video and amount of data that's coming in from Tesla's cars, for years now, they've been equipped with cameras to be able to sort of monitor their surroundings. So it's an awful lot of information coming in from its cars out on the road.
So, Craig, what might Tesla need fewer workers? Why, actually, do they need fewer workers doing this task?
So the work on automating that is still, it's a little bit difficult to sort of, unpack just how much progress they're made. They've talked about a Dojo supercomputer and sort of the training for its system being automated in a big way. They've talked about an auto labeling, product that they have developed internally, but it's really hard from the outside to sort of assess, just how far along they are in that task. What we do know, based on the reporting overnight, is that it looks like they've consolidated the work of the people doing, these tasks and shut down a facility in the Silicon Valley area and consolidated this work to another facility. Also, some workers doing this task in Buffalo, New York, where the company has had to, maintain certain levels of employment to, keep its hands on subsidies that the state has given the company, years back.
Craig, thank you so much. Craig Trudell there with the very latest, of course, on Tesla and Elon Musk. Now, at 2 p.m. UK time, we'll also be hosting a panel with the world's most influential central bankers, Christine Lagarde, Jay Powell, Andrew Bailey, and the BIS General Manager, Agustin Karsten. So don't miss, of course, that panel. That will be from Sintra. Bloomberg Surveillance Early Edition continues in the next hour with Kailey Leinz and Kriti Gupta in New York. Danny Berger will be in London, and this is Bloomberg.
Central bankers face a very difficult set of choices.
Volatility is likely to persist as long as there's policy uncertainty.
All this talk around peak inflation and peak hawkishness, and I think those two terms are being conflated in here.
There has been some signs that the economy is losing a little momentum.
The wild card, of course, is if there's some kind of contagion in financial markets.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, June 29th. Our top stories today. The pressure ramps up on the ECB to rise interest rates. Inflation in Spain unexpectedly soars to 10%. NATO says it's sending a message to Vladimir Putin. It moves one step closer to granting membership to Finland and Sweden. We're live in Madrid with the latest from the summit. And cutbacks at Tesla. The electric car maker lays off hundreds of workers on its autopilot team. Well, good morning. Welcome to Bloomberg Surveillance, the early edition. I'm Danny Berger in London alongside Kriti Gupta and Kailey Leinz in New York. Both Anna Edwards and Matt Miller are off today. And Kailey, feels like a market that's more willing to accept failure than success, not really needing too strong of a catalyst to push equities down.
Yeah, I guess the only catalyst being that all of those recession fears that have taken markets down so substantially in recent weeks haven't really gone away, even if we got a bit of a reprieve from them in recent days. That was reflected definitely in Asia overnight, where after a 4-day winning streak, Asian stocks finally snapped that rally. The MSCI Asia Pacific Index falling by about 1.3%, and really those losses were led by technology stocks, those in Asia following on the losses we saw from U.S. technology yesterday. And as a result, the Hang Seng Tech Index was down about 3.3% in the Asian trade. Now, at the same time you were seeing money leaving risk assets, you did see a little bit of that haven bid taking shape in the form of people going into government bonds, like in Australia, where the 5-year yield came in about 6.5 basis points. And interestingly, we've seen the Japanese yen fluctuating between gains and losses against the U.S. dollar. Right now, essentially unchanged. We're trading right around 136.17 on the yen. But of course, the yen caught up in the fact that the weakness spurred by the BOJ policy is maybe being offset by somewhat of a haven bid due to the growth concerns out there. But that is leaving the Japanese yen in a bit of a limbo period, Creedy. Right around this 135, 136 range is where we've been for a couple weeks now.
Well, limbo, I think, is the perfect word, Kailey, for also what's happening you're seeing in the U.S. markets. Take a look at this. Futures not doing a whole lot. They're about flat in the session here, perhaps waiting for a little bit of that economic data we're going to get at about 8:30 a.m. New York time. But take a look at this 10-year yield, the same message that you're getting, a whole lot of, well, no real conviction in either direction. Crude, though, even that, a marginal drop, only down about 1/10%, still a 111 handle. How much of that is going to change? Put this into the context of Bitcoin, even that risk sentiment indicator down 1.4%. But remember, a normal move, an average one-day move for Bitcoin is about 4%. So really, you're kind of seeing muted volatility. Once again, Danny, I wonder how much of this is just waiting for what indications we might get from the eco data in a few hours.
Well, we are getting more eco data, at least when it comes to Europe, Creedy, and it is a mixed picture. It's Spain unexpectedly surging. It's Germany actually looking like the inflation number is cooling. But when it comes to this equity market, it's this follow through from the negativity we saw in the U.S. Of course, Europe was closed when the S&P 500 fell more than 2%. So some catch up today. Germany, one of the worst performing, down 1.3%. So that means overall, it's a negative session for this equity index. We're also looking at Germany committing back to debt limits for 2023. That's, of course, after the spending spree they went on for the pandemic. German 10-year bonds, some buying here, but just lower by 3 basis points. It was much lower earlier when we got that regional Germany CPI numbers that looked soft, that looked like inflation was turning. But a lot of cross currents, be it higher CPI expected throughout the week, or you're looking at Simkus, for example, over at the ECB saying, hey, we should move 50 basis points if the inflation data is really bad. Euro dollar, that's slightly weaker, not too much movement though. That's sitting at 105.13. And finally, H&M, one of the best performing stocks in the Europe Stock 600 this morning, up 5%. It's been pretty grim for U.S. retail specifically, but Europe performing much better. H&M seeing strong pre-tax sales that exceeded estimates. Margins are also higher after repeated warnings from analysts that margins would deteriorate. So perhaps it's not necessarily that all of retail is doing well, but Kailey, it goes back to this idea, is it a stock picker's market? Can you just buy all of retail, or do you need to be very deliberate with which companies you look at?
Yeah, we've been talking about a stock picker's market and the success or failure of active management for some time, and that definitely is a conversation that continues, Danny. As for what else is continuing today, the NATO summit is still underway in Madrid. We have Finland and Sweden getting closer to joining the alliance. We'll have more on that in just a minute. Then looking ahead to 8:30 a.m. New York time, we'll be getting some economic data here in the U.S. GDP figures are due. Investors will also hear from Cleveland Fed President Loretta Mester and St. Louis Fed President Jim Bullard later on today. And the big event at 9 a.m. New York time, Bloomberg's very own Francine Lacqua will be hosting a panel with the world's most influential central bankers, Christine Lagarde of the ECB, Jerome Powell of the Fed, Andrew Bailey of the BOE, and BIS General Manager Augustin Carstens at the ECB Forum in Sintra, Portugal. Creedy.
Spanish inflation unexpectedly surging to a record, Kailey, defying that ghost government efforts to rein it in. This comes as the ECB gears up to raise interest rates for the first time in more than a decade. The ECB's Gedimias Simkus, who just spoke to Francine Lacqua in Sintra, Portugal, argued that 50 basis points should be a policy option for July. Francine joins us now from the ECB Forum. Francine, a massive day for you. Give us the latest from that ECB Forum.
Hi, Kriti. So we're just hearing also from Loretta Mester, who's talking on the panel on inflation with Isabel Schnabel, and she's very clear. She is not mincing her words. She says we are just at the beginning of normalizing this cycle. So she's basically saying, look, if we start to raise interest rates, we won't stop until inflation is under control. She says she wants to see the benchmark lending rate reach 3 to 3.5% this year, and then a little bit above 4% next year. Now, what this means for a possible recession is that there's certainly risks of a recession. Now, I'm going to try and really get to the bottom of how much pain, economic pain, a lot of the world's central bankers are willing to inflict on their economies to make sure that inflation is under control. So this will be the overarching theme of the panel a little bit later. We'll try and look at inflation forecasts, why they've been so difficult to get right. And if you're the ECB, you have a lot of a supply shock. It's from the outside. So even if you hike rates, can you really change output? And if you're hiking into the winter when there's a possible gas disruption coming from Russia, what does that mean? For the Fed, it's a little bit different. It's, of course, how far Jay Powell can go in putting the economy in a recession, what kind of recession we could see if they hike aggressively, but also what's the alternative. And then the Bank of England, of course, has a lot more domestic concerns because of Brexit. Wage pressures are going up. And of course, it's de-anchoring some inflation expectations at the margin. So we have three great panelists. And then kind of overarching all of this is Agustin Carstens. He's the BIS head. He's a central bank of central banks. He's never minced their words. He says they're late to the game, that they had to take care of inflation a little bit earlier. And so I'm expecting the panel to be entertaining and hopefully very insightful as well.
Francine, I think it's going to be the panel of the week, probably the panel of the year, to be honest. Looking forward to that. Bloomberg's Francine Lacqua and Sintra. And you, of course, can watch it, too. It'll be at 2 p.m. UK time. As Francine said, Christine Lagarde, Jerome Powell, Andrew Bailey, Agustin Carstens. Of course, if you're in New York, that's 9 a.m. Now to NATO, Finland and Sweden have taken a major step on the way to membership there. Turkey dropped its opposition, all but ensuring the military alliance expansion on Russia's doorstep. UK Prime Minister Boris Johnson spoke earlier.
If Vladimir Putin was hoping that he would be getting less NATO on his western front as a result of his unprovoked illegal invasion of Ukraine, he's been proved completely wrong. He's getting more NATO. This is a historic summit in many ways, but we've already got two new members coming in, Finland and Sweden. A huge step forward for our alliance.
Let's head over to Madrid for our coverage of that NATO meeting underway. Our European correspondent, Maria Tadeo, and Washington correspondent, Anne-Marie Hordern, join us now. Maria, kicking it off with you, just how big of a breakthrough is this?
Well, Danny, this is shaping up to be a historic but also a moment of transformation for NATO, perhaps the most sweeping changes to the alliance since the Cold War. And of course, you heard it there from the UK Prime Minister, the expectation now that by the end of the summit, NATO will now have 32 members. That would include Sweden and Finland, of course, accelerating in all of the changes that we've seen in European security as a result of the war in Ukraine. On top of that, we have some indications now from the Secretary General that Russia will now be branded a direct and significant threat to not just European security, but also NATO, and China labeled to a systemic challenge to this alliance. Of course, we're just waiting potentially moments away, if I can see it correctly here on the big screens, waiting for the Ukrainian President, Mr. Zelensky, who's also going to participate in the meeting and once again reiterate this call that Ukraine keeps the aspiration to one day join NATO, and for the time being, of course, call for more weapons for allies to be able to defend itself against Russia. That is going to be, again, the big main ask from the Ukrainian president here.
All right, Bloomberg's Maria Tadeo in Madrid. Thank you for joining us. Now let's head over to Anne-Marie. The U.S. has stressed that bringing Finland and NATO and Sweden into NATO could make the alliance more secure. So, Anne-Marie, as we look at President Biden's agenda at this summit, what kind of strategic objectives is he claiming victory on?
Well, it's this one. We know from a senior U.S. official telling us before this kicked off is this was the president's goal. He wanted to get this deal across the finish line. And it was just about a month ago, I was in the Rose Garden with the president and with the leaders of Finland and Sweden, and the president had said they meet every NATO requirement and then some. And, you know, there's been a lot of questions about whether any concessions given to Turkey to get this deal across the finish line. We know Turkey has a long-standing request for those F-16 fighter jets, and a senior administration official told us last night there were no concessions. So this is a major win for the president on the international stage here in Madrid.
Anne-Marie, of course, as you covered the latest from Madrid, I have to ask you about some of the developments going on back here in D.C. That January 6th hearing, of course, some really shocking allegations from Cassidy Hutchinson, or I should say testimony from Cassidy Hutchinson yesterday. Can you give us the latest on those January 6th hearings?
Yeah, as the president scores this win, it has the potential to be overshadowed really with what's going on back home. That testimony from Cassidy Hutchinson really painted this picture of a former president, Donald Trump, at times quite violent and a bully. There was one damning report, she said, that he leaned over into his SUV to try to grab the steering wheel, though we should note NBC says his chief head of his security detail dispute that account. There was a number of other scenarios she described of a president in rage, even at some points throwing dishes. So you can see that this could potentially overshadow President Biden's victories, the unity he is trying to have here amongst his allies in the face of his adversary, President Putin, as well as potentially China. But we should note this is just another moment where European leaders who won't really come out and say this in public, but behind the scenes, what they will tell you is that they just don't know what direction and what America they will get next.
Anne-Marie, thanks so much there. Bloomberg's Anne-Marie Horder in Madrid, also giving us a great economic indicator. Clearly, the economy of Madrid's doing well with construction going on back there. Thanks so much, Anne-Marie. Now to a Bloomberg scoop. Tesla is said to have laid off hundreds of workers on its autopilot team as the EV maker shutters a California facility. For more, we're joined by Craig Trudell, Bloomberg's global car czar. I mean, Craig, so these are hourly workers that Musk is letting go of. What happened? Because I thought he was saying it's salaried workers that are getting the can.
Yeah, that's part of what's surprising here. It's not necessarily a shock that they're getting rid of some people who do the label and annotation work related to autopilot, because the company has talked for some time about trying to automate more of that work. And this is really a matter of sort of teaching and overseeing what its self-driving system is learning and doing the machine learning that it's going to take to get its cars to be able to drive themselves. But absolutely, it runs contrary to what Elon Musk told us in Qatar just last week, that the job cuts that he has envisioned for over the next few months are going to be salaried, and that he's actually going to be adding hourly people.
All right, Tesla shares down by about 1% in pre-market trading. Bloomberg's Craig Trudell, thank you so much for joining us. Now, as for some other stocks in the move in pre-market trading, I have to point out Carnival Cruise Lines, because an analyst over at Morgan Stanley coming out swinging, slashing his price target by almost half, down to $7 a share. And he actually introduced a bear case in which the stock could literally go to $0. He was talking about the idea that bookings are slowing down, that they're facing higher costs like on fuel. All of that, he says, is going to weigh on this stock, and that view certainly is weighing on the stock this morning, with it down 7% in early hours. You also had an analyst downgrade from Morgan Stanley for Upstart. This is a cloud-based AI lending platform. It was downgraded to underweight with a price target indicating it could fall 47% from yesterday's close. Right now, the stock down 8.5% in early hours, trading around $33 or just underneath that. One more positive story out there, though, is Pinterest. It announced that its co-founder and CEO will be stepping down, replaced by Google's Bill Reddy. Investors seem to welcome that news, with the stock up about 6.6% before the bell, Danny.
All right, well, coming up on the program, from those individual stocks to the wider market, Sylvia Jablonski joins us, CEO, CIO, and co-founder of Defiance ETFs. Is she defying the sell-off in buying? And we'll also speak to Chris Hare, HSBC senior economist, as inflation numbers for various Euro regions come in. Plus, be sure to stay with Bloomberg for coverage of our panel on monetary policy, live from Sintra, Portugal. Francine will be in conversation with Jerome Powell, Christine Lagarde, Andrew Bailey, and Augustin Carstens. 9 a.m. in New York, 2 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Danny Berger in London. Anna Edwards and Matt Miller are off today. It's a reunion of the UVA crew, and in that honor, I have to do, it totally is, I have to go in honor and do the nerdiest thing here, which is look at inflation, look at break-even expectations. I know everyone's talking about inflation here, but take a look at this chart. For our radio audience, stick with me. Basically, that surge that you saw, that perhaps peak inflation that everyone was expecting in March, well, if you look at break-evens, you kind of got it, because you actually see those inflation expectations in the 10-year, the 5-year coming down a little bit. And ironically, if you actually look at shipping rates or even commodity prices or some parts of commodity prices, you'll see a pretty similar pattern. So let's bring in Lynn Thomason to break this all down for what it means for the trading day. Bloomberg Markets editor, she joins us now from London. Thank you, as always, Lynn. Lynn, let's break this down here. Some of those kind of pushers or drivers of inflation, shipping rates, rent prices, housing prices, well, some of them are easing a little bit. Are the markets going to take any of that into account?
Well, it certainly seems that, bullish investors are looking really at this kind of data for what they're pointing to as to why they want to get into this market. The idea that we're starting to see a rollover in expectations, commodity prices going down, all point to that hope that we had a few months ago that inflation would be transitory. But, look at the Spanish CPI data today at 10%. That, to me, points to really, punchy, hot numbers still coming through.
And we talk about, okay, perhaps it's a peak in yields, perhaps a peak in inflation, but it surely does not seem that it's a peak in equity. A trough in equity.
Oh, absolutely. Just look at the 3% sell-off in the NASDAQ yesterday. If anyone thought that we were past this idea of big, fearful sell-offs just ripping through the market, that is absolutely exhibit A of that we're still really much in this.
Well, and as we focus so much on the macro, we're going to get down a little bit more to the micro and look at the fundamentals when earnings season is underway. How much are expectations aligned with the price action we have seen in these markets?
My sense is it's still a big question mark. I think everyone is very curious to see what the commentary from CEOs and from company executives is going to be about inflation and whether we're starting to see consumers pull back on spending. Does that reinforce the recession narrative? Or are companies going to say, look, everything's relatively healthy. We're getting through this. It's going to be okay.
Yeah, Goldman Sachs also out warning we're not pricing in the margin compression we're likely to see. Lynn, thank you as always for joining us. Lynn Thomason from our Bloomberg team. And for more market analysis, MLive Go is where you want to head on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Danny Berger in London. Anna Edwards and Matt Miller are off today. Now, keeping you up to date with news from around the world, here's the first word. In China, President Xi Jinping is predicting what he called a final victory over the coronavirus with the country's zero COVID policy. She said that its most effective and economic approach for China is that. Beijing just cut the quarantine for inbound travelers in half, but it's still one of the most difficult countries to enter. The price of basic goods in British stores is rising at the fastest pace in almost 14 years. That's forcing poorer families to take drastic action to make ends meet. The British Retail Consortium said that shops are having to pass on some of the burden of soaring raw materials costs. Fresh food leads the surge, with prices up 6% in the first half of the year. The wife of Supreme Court Justice Clarence Thomas has declined the January 6th committee's request for her to testify. A lawyer for Virginia Thomas says there's no sufficient basis for her to appear before the panel. Emails have indicated that her efforts to prevent Joe Biden from taking office were more extensive than previously known. And Scotch whiskey is enjoying a comeback. Distillers Pernod Ricard and Diageo are shaking up the Asian industry by introducing lighter, reduced alcohol varieties. They're aging the whiskey in barrels that formerly held rum, tequila, or beer. The goal is to attract a new generation of consumers. The result? Scotch is now the biggest single contributor to sales growth at Pernod Ricard. And guys, I gotta be honest, younger consumers drinking Scotch, I'm gonna take the three of us back to our collective days at the University of Virginia and the Corner and the bar, Trinity, which is the most popular. I can't see any 20-something going up to the bar and ordering Scotch. Can you, Kriti?
I can't, but I'm just not that sophisticated. Maybe Danny's done it.
Definitely not in the college days. I would be surprised if anyone has either the taste or the budget. But guys, I gotta say, they're just trying to supplant tequila. Tequila, for the first time becoming the second biggest U.S. spirit, supplanting U.S. whiskey. So I'm sorry, whiskey, you'll just never be tequila. Maybe stop trying. All right, coming up on the program, we're going to be speaking to Sylvia Jablonski, CEO of Defiance ETFs. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The pressure ramps up on the ECB to raise interest rates. Inflation in Spain unexpectedly soars to 10%. NATO says it's sending a message to Vladimir Putin, moving one step closer to granting membership to Finland and Sweden. And cutbacks at Tesla. The electric car maker lays off hundreds of workers on its autopilot team. I'm Danny Berger in London alongside Kriti Gupta and Kailey Leinz in New York. Both Anna Edwards and Matt Miller are off today. And Kriti, it just feels like a market that any chance that we start to see stocks move forward, it feels like gravity just keeps pulling them back down. Sentiment is just so poor out there.
It is poor, but also keep in mind when you look at the trading of this week, especially, it's going to be a low volume week, light liquidity in the markets. It's also the last week of the month, of the quarter as well. So you are going to see the fact that there are some rebalancing flows. Also, you are looking at it in the face of a stronger dollar. So those foreign investors are going to look at that dollar and say, well, maybe now's not the time to hop into U.S. assets. And on top of that, we've got a long weekend coming up in the States. So is this really the time to go full on? At least that seems to be the take in the markets right now, because not a ton going on, Kailey. Futures are about flat right now. 10-year yield, I want to call about flat as well. Where you are seeing some action here is in some of those commodities. Crude is up about 0.5%. About 30 minutes ago, it was actually down on the session. So it looks like perhaps a little bit of optimism baked into the commodities market. And of course, Bitcoin, you are starting to see some of those losses get paired. About 30 minutes ago, that was down over 1%, now making its way closer and closer to flat, perhaps even positive, Kailey.
Yeah, it's pretty quiet out there, at least on the surface level, Kriti. But when you take a look beneath the surface, there actually is a little bit more movement, because there are some individual stocks on the move in pre-market trading that are worth noting. The first one being Carnival Cruise Lines. An analyst over at Morgan Stanley slashing his price target on the stock by almost half to $7 a share and introducing a bear case of $0, talking about the fact that bookings are a bit weaker and they're facing higher costs, including from fuel. And so all of that is leading to his pretty dire sentiment on the stock, which is down 7% in early hours this morning, trading around $9.58. And I would point out it's taking fellow cruise operators down along with it, the likes of Royal Caribbean down by about 3.6%. One other downside story to talk about today is Tesla. Of course, Bloomberg breaking the news with a scoop yesterday that it's laying off 200 of its autopilot workers at a facility in California that it's closing. Interestingly, most of those hourly workers, which kind of runs in contrast to what Elon Musk had told Bloomberg just a week ago, but that stock is down 1.4%. Finally, one more positive story out there, because Danny, I know you hate it when I am talking about all downside movers. Pinterest co-founder and CEO Ben Silbermann is stepping down, being replaced by Google's Bill Ready, and investors taking positively to that news, with the stock up about 3.5% before the bell.
Kailey, I know I give you a lot of grief for giving us all down day stories, but I'm afraid I'm going to be a little dour as well, because it's not a very positive European session. So you can yell at me as well after the show. European stocks, those are down 0.7%, following on from that drop in U.S. stocks yesterday. Of course, Europe was closed at the time. But the thing we're really grappling with here is this dangerous mix of stubbornly high inflation and growth figures that don't really seem to be picking up steam or dropping enough to help put inflation back down. Spain unexpectedly rising to 10% for their CPI figures this month. I should say there was some regional German data that did suggest some slowing down or cooling in the inflationary story. Despite that, we are seeing some bond buying going on, just 2 basis points lower, though. That's because, again, we're really having a hard time figuring out exactly what that inflation story is. You also have ECB members going against Christine Lagarde, saying, hey, we should give ourselves optionality to go 50 basis points next month. Euro pretty much flat. Gonna pull a Kailey. I'll end on a positive story. H&M sales very, very strong, exceeding analyst estimates. Margins also strong, despite some low expectations of rising cost pressures, Kailey.
All right, Danny, well, let's take a bigger picture look at these markets now through the lens specifically of ETFs, because the ETF bulls seem like they're done chasing this market. After 3 5% bounces that failed to endure, investors have pulled roughly $10 billion out of equity funds during last week's rally. The outflows are adding further evidence to souring investor sentiment. Joining us now is Sylvia Jablonski, CEO, CIO, and co-founder of Defiance ETFs, up early for us in New York this morning. Sylvia, what do you make of the flows we're seeing and what that indicates about the level of bearishness out there?
Hi, good morning, Kailey. Great to be here. Well, I think that it's sort of par for the course with what we're seeing in the market. So we've had last week felt a little bit like a bear market rally. And here we are kind of turning back. So, as you alluded to, it didn't sustain for as long as we thought we would. And I think that it's sort of the same story, whether it's ETFs, whether it's crypto, whether it's equities, investors remain on the sidelines now. And they're sort of afraid to dip their toes in because of the uncertainty around inflation, whether or not the Fed can execute a soft landing, how earnings season's going to be. And there's also just no liquidity in the market this week because of the holiday, I think. And we're off of that Russell rebalance. So it's going to be a little bit of a slow and choppy week.
Is there anywhere that you're not afraid to be dipping your toes in, where maybe there is a buying of the dip opportunity, Sylvia?
Yeah, so I'm actually not afraid to dip my toes anywhere at this point. I'm not calling the bottom, and I agree with some of the former guests that you've had on that have said it's not necessarily compelling to just go out and buy today, particularly during a holiday week. We might not get that rally in the short term, but I look at it in two different ways. So for a 401k plan for a younger person, somebody investing for the long term, dollar cost average in. It doesn't matter whether it's this week or next week if you're sort of getting it 2% lower, 2% higher, you're sort of in a fairly tradable bottom range. And I think that that'll really pay off in the future. And I particularly like quality names when we talk about that, both quality ETFs that represent sectors that will grow in the next, 5 to 10 years or so, and just quality names that have been beaten down. Some of the tech names, for example, Apple got hammered yesterday. We have Alphabet, we have Amazon, semiconductors like NVIDIA and AMD. I mean, these are great bargains in the market for long-term investors.
Sylvia, on the flip side of things, in this type of environment where there's a lot of volatility, is there any importance in holding that optionality of cash?
It depends on who you are and what your personal situation is, right? So I think that investors, you want to have some cash on the sidelines for sure, some dry powder to implement in case we don't get that soft landing and we see a further leg lower. But I think, you have all three indices in bear market territory, touching correction territory, at least S&P, NASDAQ decidedly in bear territory. A very small percentage of the S&P 500 is trading above its 50-day average. Put call ratios are higher. Consumer sentiment is just absolutely awful. And I think that, these aren't all of the check boxes that indicate recession and market bottom, but they're calling for bottoms, right? So you can have some cash on the side to deploy if things go down further. But I think, if you don't sort of need the money to live on and you're, liquid enough with your daily expenses and things like that, putting money to work in the market over time is usually what works. Unfortunately, none of us are smart enough to call the exact bottom. So, dipping your toes in on these pullbacks, 25, 30% pullbacks in major indices, I think is, the second time we've had that opportunity since COVID, and before that, a decade before. So, I look to buy in these times.
Sylvia, let's broaden this out perhaps and look cross-asset here, because I'm curious on a benchmark level what the signals are in the markets. Is it yields that perhaps benchmark investors are looking at? Is it the inflation story, oil prices? Is there any kind of cross-asset moves that you're watching in particular to say, well, okay, if yields go up, the S&P 500 is going to go down, or vice versa?
Yeah, so yesterday was actually interesting because it didn't happen in the 10-year, right? The 10-year seems to be steadying at about 3.2%, and then we saw complete carnage of the market. So that's been, a little bit of a separation as compared to prior weeks. It's interesting, but what I'm really looking at is just inflation, and I think inflation is going to tell us a lot. It's going to tell us, how hawkish the Fed needs to be, how many times we think they'll raise rates, and whether or not that soft landing comes along. And I think that until we get consistent inflation reads, or even just like a good surprise, investors are going to be wary and staying on the sidelines.
Okay, so Sylvia, when you look at the biggest risk to the equity market right now, inflation, recession, which one wins out?
I think inflation, and I think that would be potentially one of the big catalysts that move us to the latter, along with, the Fed sort of going too fast, too strong because of it. So I think it's inflation. If we have a recession, the interesting thing about talking recession, right? When you think about recessions, you usually think about something that's very pervasive, very profound, and just something that attacks essentially the entire macro environment in the market. And we still don't have all of the ingredients for that recipe, right? Jobs are still pretty strong. The consumer's pretty strong. I get that sentiment is terrible, but the fact of the matter is they do have cash to spend. And you are getting some lightening up in housing starts and things like that. Geopolitics, of course, is another potential headwind. China closures are a potential headwind. Good news yesterday, but maybe not today. So all of these things matter. But I think even if we get a recession, it's going to be, or it's likely to be, short-lived and not as big as we think. I think that we have a shot at a soft landing too, but I do think that the market won't be steady until we sort of prove that.
Sylvia, great to get your thoughts this morning. Sylvia Jablonski of Defiance ETFs. Now, coming up, Morgan Stanley predicts a euro area recession in the final quarter. Does Chris Hare think so as well? HSBC senior economist. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Port of LA Executive Director Gene Soroka. That's at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Kriti Gupta and Kailey Leinz in New York. Anna Edwards and Matt Miller are both off today. Now, Morgan Stanley economists are now expecting a euro area recession in the fourth quarter of this year. They blamed reduced energy supplies from Russia and falling confidence, sort of the usual suspects. Well, joining us now is Chris Hare, senior economist at HSBC. So Morgan Stanley, recession, fourth quarter this year. What say you?
Not quite a recession, but the Eurozone economy is entering pretty dangerous territory. I mean, in terms of numbers, we've got growth pretty much flatlining in the second and third quarter of this year. That inflation squeeze on household incomes and household spending is really significant. We do have a little bit of recovery going on later at the turn of this year and into next year, but there are those big risks out there. To what extent is household spending going to hold up given that real income squeeze? And to what extent should we be worried about gas rationing? And that could be another negative factor too. So we don't quite have a recession. We've got a flatlining in the middle of the year, but it's likely to be a pretty challenging few quarters ahead.
And we heard from Christine Lagarde yesterday reiterating this idea of optionality and flexibility. But given we were just talking about in the break how volatile this data is, should they be giving more flexibility and not saying, OK, we're definitely going 25 basis points in the next month?
Well, the hope is, or indeed our expectation, is that when you think about that growth danger zone, it's more in the near term when we're thinking about the real income squeeze, when we're thinking about gas rationing. But then ultimately, at the same time, inflation is incredibly high. We expect Eurozone inflation to be above 8% until at least September this year. And from there, it's only likely to fall relatively gradually. So I think it's right that the ECB does have to get with the programme and signal the prospect of significant rate rises in order to help inflation back down when we go into next year. But of course, monetary policy works with a lag, so to the extent that we think that there may be scope for some underlying improvement next year, that's the point at which monetary policy kicks in terms of its disinflationary impacts.
Well, but let's not look so far into the future as all the way to next year. Let's just look toward July, because as Danny indicates, Christine Lagarde says the move is 25 basis points, but you have other members of the Monetary Policy Committee saying, well, we should leave the door open to 50 depending on the data. What do you view as the likelihood that we actually get a larger move in a couple weeks?
I think there is a possibility. For what it's worth, you're right, Christine Lagarde has signalled the possibility of 25 basis points, similar to Chief Economist Philip Lane. And if anything, more of this potential flexibility or optionality in terms of the magnitude of rate rises could come in the September meeting. Perhaps the difference between July and September isn't all that big in terms of the medium-term inflation outlook, but potentially there is that risk. You know, what if inflation prints and the Eurozone inflation print later this week comes out really strong indeed? Then maybe there will be a little bit more market pressure and pressure on the Governing Council to think, well, is that 25 basis points enough? But then, of course, alongside that rate rise, the ECB needs to think about this anti-fragmentation tool in order to bring about not too disorderly an increase in peripheral bond spreads. So there really is a lot on the ECB's plate. It looks like 25 basis points for the upcoming meeting. But yes, there could be pressures to think about more, or at least signal quite a bit more further down the line, given that strength in inflation.
Chris, let's fold in the G7 here because, of course, we know a price cap on oil is part of the conversation. It's something that Pedro Sanchez has even tried to implement on natural gas prices in Spain. Speaking of that Spanish inflation, I have to ask, though, does that make any difference in terms of the ECB's path? Do they see any impact from that?
Well, to some extent. I suppose traditionally you should think that central banks would tend to, quote, look through energy-type shocks because they are transitory influences on inflation, although the word transitory has really fallen out of favour over the last few months. I guess it could help at the margin if something were agreed on an energy price cap. To the extent that it keeps a lid on inflation in the near term, that might then in turn reduce the risk of concerning trends in inflation expectations and so-called second-round effects pushing up on wages and making that inflation more self-fulfilling and more persistent. So yes, it could help at the margin, and it could also help rebalance the policy response. If you have a price cap on energy prices, then maybe governments may not have to step in quite so aggressively with fiscal measures in terms of handouts for households, for example. So it may be an attractive development in the policy mix, but let's see what actually comes out of it.
Well, Chris, you point out that transitory is a word that we're retiring from the vocabulary, but it seems like fragmentation is the new one that's taking its place, perhaps, or anti-fragmentation, I should say. To what extent are we seeing a repeat or a parallel of what we saw in 2011, 2013 with the Eurozone crisis?
Well, things don't nearly seem so severe as that. If you look at peripheral bond spreads, Italy, certainly Greece, for example, things are much less severe than we saw in 2011. And of course, as the policy response eventually we had from Mario Draghi, whatever it takes, backed up eventually by policy measures such as the OMT program in order to contain those peripheral bond spreads. What we're seeing now certainly isn't as severe as that, but it looks like we do have to see strong signalling from the ECB. Perhaps not whatever it takes, but some significant measures we think do have to come along in terms of a potential anti-fragmentation tool that turns out to be credible. And if it doesn't turn out to be credible, then there's that potential risk of persistently high peripheral bond spreads, which will be a weight on economic growth and might ultimately slow down the pace at which policy rates can increase. So, as I say, it's not quite so severe, but it's a really significant thing that the ECB, we think, needs to get right over the next month or so.
Yeah, certainly the politics making its way into the economics. Chris, thanks so much for joining us. Chris Hare there of HSBC. Now stay with us for Bloomberg's coverage of the monetary policy panel live from Sintra, Portugal. It'll be hosted by Francine Lacqua in conversation with Jerome Powell, Christine Lagarde, Andrew Bailey, and Augustin Carstens. 9 a.m. in New York, 2 p.m. in London. This is Bloomberg.
Central bankers face a very difficult set of choices. They can either bring inflation down, but at a very heavy cost to the real economy. They'd have to essentially crush demand, raise interest rates very much in order to get inflation anywhere near the 2%. Or they can, at some point, accept that that cost is too high and to tolerate for some time higher inflation.
Philip Hildebrand, Vice Chairman of BlackRock, speaking with us here on Bloomberg Surveillance Early Edition yesterday. Now, Tom Keene, co-anchor of Bloomberg Surveillance, the original, joins us now with his single best chart of the day. Tom, what you got?
Well, what I got is a really simple chart. It's a little misleading. I'm going to explain it through carefully. Here's a boring chart. It is the GDP of America taken as a presidential moving average, 4 years, 16 quarters. And it's very subtle. And you really can't see it on the chart. Before the great financial crisis, the run rate of our economy was 3.4%. And right now, it's 2.4%. And of course, trending down as well. But that's a difference over a good number of years. We moved down a figure from 3.4% to 2.4% economic growth.
Tom, tell us about your guest lineup. Who are you going to ask about this?
Well, we've got a lot of people coming up. I think most importantly, we've got Kit Jukes before Francine's important panel in Europe. And I really look for Kit Jukes to show us stronger dollar in the linkages here of the central bankers as we go to 9 a.m. there.
All right, well, we're counting down the clock, just about 3 hours to go, but just a couple minutes to go until Surveillance starts. Tom Keene, co-anchor of that show, thanks so much. Looking forward to watching over the next couple of hours. Now, as for what else we're watching today, I'm going to be paying attention to earnings, specifically from General Mills, which is due to report before the bell. And guys, why I'm interested in this is because obviously it's related to food, costs of which have gone up for the American consumer. And for General Mills, they are expected to see sales growth, not necessarily because of volume, but because of those price increases, raising the prices on their products in order to offset some of those higher costs. My question is, how much are they going to continue having success doing that as the American consumer, hit by inflation, starts to penny pinch a little bit more? Obviously, food is a necessity, unlike some more discretionary items, so maybe the elasticity is a bit different, but it's definitely going to be interesting to see what kind of commentary we get out of General Mills, especially looking ahead, what that outlook looks like, Creedy.
Well, especially, Kailey, if they talk about that crazy R word, the recession.
Right.
Of course, that's going to be crucial as we talk about whether or not we're actually in one, which brings me to the eco data we're actually going to get today. Some of those revised GDP numbers from the first quarter, you are going to get those numbers out today. And remember, it's really going to see some tiny tweaks here and there. But the question here is, what is the directional trend? You're also going to get some personal consumption data. And, of course, that core PCE quarterly data. Of course, the PCE deflator we're going to get tomorrow as well. So there is a lot on the docket to keep an eye on. I wonder, though, Danny, if the markets will actually react to it.
And will any central bankers react to it? And there will certainly be an opportunity for them to do so. I am watching, and really everyone should be watching, Francine Lacqua's panel later today. It's going to be at 2 p.m. if you're here in the UK, 9 a.m. I believe if you are in New York. It's got Jerome Powell on it, has Christine Lagarde, Andrew Bailey, Augustin Carstens from the BIS. I don't think that they'll be asking about General Mills, Kailey, but look, all that data will be in there. And Christine Lagarde has a lot to answer for. We're seeing different ECB Governing Council members coming out and speaking. Vunch is speaking right now. Kailey, I know you're pointing this out, talking about 150 basis points of hikes by March being reasonable. I mean, Kailey, that's a lot of cross currents with Christine Lagarde, who is committed to that 25 basis point hike next month.
Yeah, how much is she really reflecting the consensus on the governing council? Or is she kind of alone in wanting to keep a move of that size? It's interesting looking up here, Wunsch's commentary here. He's pointing to fiscal policy, basically saying that if it stays supportive, we're going to have to do more. So we have to keep that in mind, that it's not just about the monetary policy response to inflation, more so as well the fiscal policy's potential to fuel that, and how central bankers may having to find themselves offsetting that to the extent that they can.
I find that point so interesting, Kailey, because it's the politics of fiscal government that knows its populace does not like inflation. Of course, who would? Trying to do something about it. But does that mean they're just making policy more easy? Well, that's it for us at Early Edition. More surveillance ahead. This is Bloomberg.